Do you feel that quiet? That stillness? That pause you're noticing right now is the market holding its breath. At this very moment, silver is trading at $65.77. It's not collapsing. It's not surging higher. It's simply sitting there, steady and unmoving. To most people watching a screen, this looks dull. They glance at the chart and say, nothing is happening. The move is done. But for experienced traders, this kind of silence is loud. This is not boredom. This is pressure building. This is the moment where two powerful sides are facing each other, neither willing to blink. We are nearing the most important moment of the entire trading week, the weekly close. For the past 5 days, the banks have thrown everything they had at this market. They raised margins, they increased short positions, they tried hard to force silver back down to $60, and they failed. Look at where we are now, $65.77. We are still holding firm. Silver refusing to fall at this level is one of the strongest bullish signals I've seen in 40 years. In this update, we're going to explain why this Friday close matters so much. We'll look at the weekly candle and why holding this level activates automated buying systems, and we'll explain the tight price pattern forming right now. The pressure is extreme, the setup is complete, and when this releases, it won't be quiet. The banks did their best, and the market barely reacted. Let's break down why. Why do I keep talking about Friday? Why does it matter whether silver closes at $65 or $64? Isn't it just a number? No, it isn't. In institutional trading, daily price movement means very little. Hedge funds don't care what happens on a random Tuesday morning. What they care about is the weekly close. That's the final score. It shows who controlled the market for the entire week. For the last 3 years, every time silver tried to break higher, the banks used Friday afternoons to knock it back down. They would dump huge amounts of paper contracts right before the close. The goal was simple: make the weekly candle look weak. They wanted long upper wicks. They wanted charts that scared technical traders away. But today is different. We are trading at $65.77, right near the highs of the week. If we close here, the weekly candle will be a strong, solid green bar. In technical terms, it becomes a Marubozu candle, a candle with little or no wick. That tells the market one thing clearly: buyers stayed in control from start to finish. This sends a direct signal to Wall Street algorithms. It tells them the breakout is real. It tells them selling pressure is exhausted. Most importantly, it activates trend-following systems. These systems manage billions of dollars. Their rules are simple. If price closes the week above resistance, they buy on the Monday open. Resistance was $65. We are above it. If we hold this level for the next few hours, those buy orders trigger automatically next week. That's why the banks are nervous. They know the machines are watching, and if they fail to push the price lower before the close, they will face a wave of automatic buying. That calm price at $65.77 is not weakness. It's the quiet before the algorithmic surge. Now let's look at the chart pattern. When a market moves up too fast, it usually needs a pause. Silver ran from $60 to $66 quickly. Moves like that don't last forever. Normally, prices pull back hard after a run like that. But silver didn't drop. It stopped and moved sideways. It stayed in a tight range between $65.50 and $66. In technical analysis, this is called a bull flag. The sharp rise is the flag pull. The sideways movement at the top is the flag itself. This is one of the healthiest patterns you can see. It shows profit-taking is happening, but new buyers are stepping in immediately. Sellers exit at $66, buyers step in around $65.80, and the exchange happens smoothly. The price doesn't fall. This is known as absorption. Buyers are quietly taking everything sellers offer without letting the market drop.
Right now, the pressure is balanced. That's why price looks flat at 65.77. But the banks can't hold this forever. The moment they step back, the price doesn't rise slowly. It moves fast. This pattern is the market building energy for the next leg higher, with $70 as the next target. So don't be bored by sideways action. This is where major moves are prepared. There's also a psychological battle happening at $65. For many investors, $65 used to feel impossible. People said, if silver ever hits 65, I'm selling everything. Well, we're here, $65.77, and most people aren't selling. Some traders took profits, yes, but the mass selling never came. Long-term holders stayed put. ETF investors stayed in. Why? Because people now understand that $65 is not the end. They look at inflation, they look at debt, they look at the Samsung battery developments, and they realize that this is only the beginning. The banks expected panic selling. Instead, they found conviction. That shift in mindset is how long-term bull cycles are born. When high prices no longer reduce demand, but actually increase it, trends accelerate.
And let's not forget what didn't happen today. It's Friday. Historically, Friday mornings are when silver gets hit. Jobs data comes out, the dollar spikes, silver drops. We expected it. It didn't happen. The reason is simple. The physical market is tight. Dealers are low on inventory, refiners are slowed. Every attempt to push prices down creates more physical buying. The banks can no longer crash the market. They can only delay it. That creates a solid floor at $65, and we're standing on it right now. Now, let's talk about what happens after the close. When the clock hits 5 p.m., the market shuts down, but the systems don't forget. Over the weekend, trend-following models update their data. If we close above $65, billions of dollars in automated strategies switch from waiting to buying. This buying is not emotional. It doesn't care about headlines. It simply executes. That's why Monday mornings after breakouts are often explosive. The weekend itself also matters. In a bull market, holding cash becomes risky. News doesn't stop just because markets are closed. If something breaks on Saturday, there's no way to buy until Sunday night. If silver opens higher at $67 or $68, anyone holding cash just lost buying power. That's why people aren't selling today. Holding metal feels safer than holding currency. The media is changing too. For years, silver was ignored or mocked. Now, headlines are shifting. Silver outperforming gold, solar demand tightening supply. This matters because mainstream investors follow narratives, not charts. When the media validates the story, public money enters, and public money moves markets the most. Technically, the road ahead is clear. A 45-year cup and handle pattern is resolving. From the $4 low in 2001 to the $50 rim, the measured move points to $96. We're currently at $65, early in the process. Fibonacci extensions place the next major target near $72. Between 65 and 72, there's very little resistance. Price can move quickly. The RSI may look high, but in strong bull markets, overbought signals strength, not weakness. The weekly RSI is nowhere near historical extremes. Finally, the most important skill right now is patience. Doing nothing is hard, but it's often the most profitable move. The trend is intact, the shortage remains, the breakout is confirmed. This week wasn't about hope, it was about proof. The bulls won, the floor is set. The next fight is $70. Enjoy the weekend. This time, the closing bell doesn't sound like relief. It sounds like victory.